Hi Shefali, welcome to Startup Simplified. How are you?
I'm good. Thank you for having me today.
Pleasure, absolute pleasure. Shefali, let's just start with a very quick introduction, right? I'll let you do that the way you want to. You can basically give us a very brief journey of yours in terms of what's been your background and what do you do at Insignia.
All right, sure. So I'm Shefali. I'm actually part of the investment team at Insignia Ventures Partners. I actually started out my career in banking first, was a few months, and then I moved to a local fund called SkyStar Capital. I was there around 3 years. So I actually started out in my VC journey quite early, back in 2018, when at that point there were very few funds.
Sure.
Post that, I joined an e-commerce company for around a year, after which, I was inclined to move back to the VC ecosystem, just because I really enjoyed the breadth. So that's more so on my professional career. On the personal front, I actually grew up here in Indonesia, spent around 9 years of my life actually in India and Hong Kong. After which, I chose to come back here to pursue my professional career. Yeah.
Nice. How does one get into venture capital world out of college? How does that happen?
That's a very good question. I think it's uncommon, I would say. But I was fortunate to have, met someone who told me a little bit about the VC ecosystem very early in Indonesia. And I was very much exposed to the VC ecosystem in India as well, right? So at the point of my return, I think we already saw a few unicorns. There was Lazada, for example. They got acquired by Alibaba for $1 billion, right? So that happened around the same time when I came back. And I knew that there were a few VC funds here. And fortunately enough, I think I knew a few people at the fund, right? So at the end of the day, I had it good because I knew how to do BD and finance. And I think VC falls perfectly in that two focuses, right?
How does VC fall in the BD category?
You originate your own deal.
Oh, you originate your own deal. Okay.
Yeah. Okay. Which is, I would say, very uncommon, right? I think even in banks, a lot of the clients are brought forward by partners.
Correct.
So being in the VC ecosystem very early gave me a high, I would say, sense of ownership. Yeah. Which, I would say I was just very lucky to know the right people at the right time.
No, definitely. That always helps. I've been itching to ask this to someone over my podcast, and it's very unfortunate, but you are the first female guest on the podcast. And I say this with complete sensitivity, okay? Why do you think there are so less women in the VC ecosystem? Founders also, to be honest, entrepreneurs also. But let's talk about the VC ecosystem. Why do you feel that it's so male dominated? What's your thought?
Zoom out a little bit, right? I don't think it's a VC problem. I think it's something that you see across the finance industry, right? And, it's long dated. It's not only in Indonesia. I think you see that even in more developed.
Correct.
Two things, right? One is exposure. I think at the end of the day, females in general, I don't want to generalize, but they tend to resort to career paths that are more marketing influence or operational influence. That's the trend that we've been seeing, right? But surprisingly enough, that's changing. So in the present day, I think even if you look at the VC ecosystem in Indonesia right now, actually a lot of the analysts, associates, even to mid to senior level, now there are a lot more females, and we're seeing actually a lot of females rise to the top.
Oh, that's amazing.
Right?
That's amazing.
But the journey has been rather slow.
Yeah, I think venture world is also a reflection of the society as such, right? I mean, the participation has been lower in the developing countries either ways. Yeah, fair enough. Makes sense. Before we get into Insignia and the world of venture capital, just very quickly while we are on this topic, if there is someone who's aspiring to venture into the VC world, how do they go about it? Let's say they don't know anyone out there. Let's say someone who's just straight out of college or someone who has had some finance experience. How does one go about it?
I would recommend them to be very proactive. Even if there are no networks in place yet, you can create those networks, right? By as simple as reaching out via LinkedIn.
Networks with people in the venture capital.
Yeah, or even, entrepreneurs. Actually, that goes a long way, right?
Sure.
I've had a lot of emails itself, reach out to me asking about my journey, right? So I think we are quite lucky because now there's LinkedIn, right?
Correct.
You can reach out to anybody and everybody.
True.
And if you look...
Don't overdo it, please. Don't overdo it.
Yeah.
Okay, let's talk about Indonesia and the market as such, purely from an investment perspective, from a venture side perspective. So you guys have been active in Indonesia for how long?
Since 2017.
2017. Okay. And it's a pretty sizable portfolio which Insignia has in Indonesia. Yes. Right. Just let's talk about the journey, right? You've been with Insignia for 2.5, 3 years now.
No, it's not even been 2 years. It's been a year and 10 months.
A year and 10 months. But you've been in the venture world for a while now, right? So let's talk about the journey, let's say starting 2018 or something like that. How do you think it has progressed so far? What are the changes which you've seen?
A lot has changed.
A lot has changed? Give me something.
I recall when I first joined the industry in 2018-19, I was looking at like seed stage deals that were valued at 1 or 3 million valuation. I think that's where you can start, right? But if you look at the present day situation, although I think the market has largely corrected, the seed stage valuation still range up to 10 million. That's okay. Yeah, and that's like I'm looking at the lower side, right?
Okay.
Even seed stage happening at 40 million, 50 million valuations. But, that's a big change, right? We are seeing that the ecosystem, as it matures, we are also pulling in a lot more aspiring entrepreneurs. They're more inclined to start their own businesses, raising money from VCs, which was very uncommon.
I think the education has gone up when it comes to entrepreneurship, and the access to VC money has gotten better, right?
Yes, correct. And that's one thing. That's the valuation part, right? I think the second is the terms that you see in shareholder agreement, share subscription agreements, right? Now they're, I would say not exactly like what you see in the US, but they have become more complex.
Okay.
Right? They
didn't used to be complex in 2017, 2018.
But not
as complex.
The terms have developed a lot over time as well, to protect both, the founders and the investors as well, right? I think lastly, what I've seen is the landscape has changed, right? I mean, what we are investing in 2018, 19 versus now is very different, right? I think back in 2018, 19, we saw a lot of P2P companies.
Correct.
2018 was a year for ride-hailing companies becoming unicorns.
Correct. Yeah.
But then today, we fast forward, I think we're seeing a lot more fintech companies in the embedded financing space.
Correct. Which is more B2B and ease of profitability is better.
Yeah. I was also quite lucky to see the whole, I would say, trend and change in, POS Gen 1, POS Gen 2, then have Gen 3.
Yeah.
That whole evolution of various sectors is something that I have been fortunate enough to witness from 2018 to date. Yeah.
Okay. Let's talk about the research, right? It was one question which I wanted to ask either ways. What kind of research generally you do, right? So, for example, let's say you're meeting someone who's in a generative AI space. I'm just taking a very hypothetical example. The buzz, right? Let's say someone is in a generative AI space and you're meeting the founders. Maybe you reached out to them, they reached out to you. Let's forget that piece. There's a meeting which is happening. So what kind of research would you go about doing?
Fair enough. a lot. So I think the first
Let's just break down. Let's break down like in parts. What kind of industry research? What kind of founder back profile? What kind of past companies have been created in that space, or whatever more you took.
that. I think the first thing we try to understand is, how big the market is.
Okay.
Who are the incumbents in the market?
Mm-hmm.
In reality, how much of the market is left for this company that's building? Secondly is, of course, looking at comps, right? I think it's a very common theme that all VCs look into. Looking at what worked in India, what worked in the US, and what were their business models and demographics at that point in time when they were building, right? And drawing that parallel to Indonesia.
Do you think it's a fair thing to do? I mean, Indonesia is very, very different, very unique. Okay, we'll come to that. Okay, please continue on the research.
Then thirdly is, I would say business models are very important, right? We really trying to understand how are they making money here versus making money abroad. Right now, for example, I think in US software is common, subscription is common.
Correct.
But in Indonesia, not necessarily that really work, right? Depending on what industry you're in. So really understanding the nuances and not being blinded by what works in India and the US to work in Indonesia, for example. So the research is more so on, I'm just recapping, market, how big it is, who are the incumbents, maybe what are the regulations that's surrounding the market, and also what are the local nuances and business models that we've seen.
Sure.
So really when we go in meeting a company, you're not entering blindly. Right?
Correct.
You know what they're building and who they aspire to.
Sure.
Yeah.
Sure. How about founders? I mean, what kind of green ticks you look at? Meet from a founder's profile perspective. What do you look at?
Okay, I'm gonna answer this from a very high level.
Of course.
Point.
Yeah.
We like founders that have domain expertise, right? Or even if they don't have domain expertise, the willingness and motivation to learn, unlearn, and proving to be resilient. I think in this kind of climate, it's very difficult, right?
Yeah, I mean, I've been speaking to a lot of VCs on this podcast and off camera as well. Two words rather, which keep coming back are grit and resilience. Okay. How about academics? How important is academics in a founder's profile?
So that's something that has changed as well, I think back in 2018, 19, we would really look at the CV.
Yeah.
They graduated from HBS, Stanford. It's good. That goes to show, they can, they work really hard to get into those universities and they've succeeded academically, right? In case in point, I think in Indonesia, if you're building something, it's not so much about CV anymore. It's about, operational execution, whether you know the right people, you know how to navigate the market.
Correct.
All that can't be studied through academics.
I think, it used to be the case. I mean, in hindsight, even when I look, what I've figured out is that a great university degree actually does not have very high correlation with being a successful entrepreneur. I mean, it is good. It is good to have one, but irrespective of that, you might succeed in entrepreneurship with very different attributes.
Yeah. Actually, there's a study that Insignia did as well, right? Based on the US landscape, whereby they try to understand unicorn founders. What proportion of these founders actually went to masters,
Correct.
Any master MBA or any masters for that matter, and what are the other founders that didn't reach unicorn status? Pursuing masters. Actually, the percentage is the same.
Yeah.
Close, plus minus 40 to 50%.
Well, I mean, look, it's a great number, but we still have to understand that this part which comes with a good university degree has always had a very easy access to capital because of two things. One, right, it's more of getting the first check effect, and then he or she recommending the peers to the venture capital. So it becomes a bit easy in terms of network. You look at India, for example, it's completely dominated by the IITs and the IIM alumni. The reason was very straightforward because it became kind of a benchmark in the beginning. So the whole volume is very lopsided. Because, I mean, and it's pretty fair, right? I mean, you create this massive network, it definitely helps. But yeah, I mean, this study is very interesting because you're talking about one side, which is very fragmented, and the other side, which is very united to a large extent. And if they both are in a similar proportion in terms of success, it's a pretty interesting one.
Yeah. So
Okay.
it goes to show, I think it's not only about education, right?
True. Let's talk about Indonesia. How big is really the market? What do you think? What are your thoughts?
For which sector?
Let's say, for example, I am building a D2C brand. Okay, I'm building a D2C brand. I'm building a mid-tier D2C brand. Let's say I'm building something in wearables, earphones, smart rings, and wearables basically. Okay, and I want to size the market. Okay, how big do you think is the market?
Okay, it depends. I think first we need to categorize, I guess, the larger companies, right? Like that are focusing more so on the mass market, like Xiaomi, for example. You know, what's the average price? Let's say in this case, a wearable, right? Let's say a smartwatch. You know, what's the average price they're going for? And they're targeting more so the mass market.
Sure, I'll give you all the parameters. Okay.
This sounds like a case study.
Yeah, let's do this. Let's do this together. Okay, let's do this together. Let's say we are talking about only 3 product categories. Okay, smartwatch, let's say a smart ring, and headphones, right? And everything is in a price range of let's say 600 to 900,000 rupiah. Okay. Now, what do you think is the size of the market in the country? Yeah.
So I would categorize the SE, SA, B, C, basically the income class population of Indonesia, right? I think if you're talking about 600K to 900K, you're definitely not targeting the high income.
Yes.
The high income earners will go for the likes of
Apple, correct.
Right? Or even Huawei that has like, 5 million smartwatches. So then in that case, you're looking at maybe the population that's earning at least minimum wage of 4 million, right? 600K falls quite nicely. Use the wearable for 3 years. So you're looking at around, I would say, 80% of the population, right? 80% of, 276 million, right? So that's how I would go about it. But in reality...
Give me that number. Give me the real number.
In reality, when it comes down to Indonesia, distribution is not easy, right? Even if you sell a product, does not mean you can sell products to all the cities at scale, right? You need to have the right warehouses in each city, the large distribution network to tap into areas within the city. So even if you target Jakarta, for example, right? Maybe you can target 30 to 50% of Jakarta's population if you just start out with Jakarta.
Okay.
So in reality, actually, it's not as easy to build distribution in Indonesia. And even if you do simple math, 80% times 276 million times, let's say 600,000, that is your TAM.
Yeah.
But your real addressable market would be based on the geography populations that you're targeting.
You must be getting D2C pitches, right?
Yes.
What kind of TAM generally people or aspiring entrepreneurs or founders mention?
Then so with BPC, I think
what is BPC, please?
Beauty, personal care. That one would be around $8 to $9 billion, right? And market size.
Okay.
But then you have to ask yourself, out of the 8 to 9 billion, the instruments have how much of this market?
I'll share something on the market size. Okay. So this is something which we have gone through at GoTo. So as knife founders, when we started, we're very naive, right, in terms of market size. We're like, okay, listen, let's do a very simple maths. We're talking about a 270 million population as per the last census. People above the age group of 18 is close to 190 million. There is a 95% penetration smartphone, 95% internet penetration, 95% literacy rate, read, write, bahasa. So that becomes close to 150 million. That's the market size. Okay. And well, like, okay, this sounds fair. Let's start, right? So problem with starting with that premise is that now you have taken the whole country out there as acquisition, right? So you're going after everyone. And the numbers were absolute nonsense, right? Be it in terms of retention, be it in terms of time spent. And I'm like, no, this is not correct. There's something wrong, right? We are a media company, right? Media technology company. It's news. It's free with what we are offering. But then we had to go back to the drawing board and figure out that, hey, listen, we can't keep going this way because the numbers are not working. So we decided to focus on a segment based on their income, which is a very weird call because we are a media company, but we still went ahead with that. And based on the World Bank data, there are close to 45 million Indonesians who are in a range of monthly income of 10 million rupiah and above, right? So these are basically the white collar folks, people like you, Achmat, our camera guy over here, right? So we decided, okay, let's target these, right? So of course your TAM has become very smaller, but once we started doing that, the numbers shot up. I mean, our average time spent every day went from 3 minutes to 9 minutes. Lesser number of people, but they're consuming a lot more content, spending a lot more time. They're very interactive with the app, right? So we learned our market that way. What is a general rule? Like, what advice do you give to founders when they're sizing the market? I understand it depends on industries, but let's just give us a general piece of wisdom.
I think for us, we would deduce the market based on, again, as I mentioned, geography, right? The next 5 years, which cities are you targeting? In this case, for, consumer product, right? Second is, in reality, if you're selling your product online, which is through e-commerce or, your own website, what proportion of that population is actually online? Right? Because if you target more so the tier 2, tier 3 cities, actually, they're still very much offline. So
Correct.
You can't do simple math there.
Correct.
Right? So first rule of thumb is population by city. Second is how much of that population is online. And third is as simple as what is the average order value and how many times per year are they going to buy your product, right?
Correct.
Yeah. Because at the end of the day, you can't also assume the same population will buy, let's say, a wearable every year.
Correct. Right? Correct.
So it's important to also categorize the frequency depending on the product you're selling. I hope that.
No, it does. To a large extent, it does. I mean, there's a lot of lingo out there, but it does. Let's just finish this loop about D2C, right? Still quite a few companies, quite a few startups which basically do 90% of their sales on marketplaces, right? Wherein the other 5-10% happens on their own channels, be it a website or their app, if they have one, right? What as an observer, I'm not asking your opinion as VP investments at Insignia, but as an observer, what do you think? I mean, do they fall into the category wherein they should be raising venture capital money?
Which sector are you referring to?
Let's say, for example, a D2C wearables, for example, which is a fairly let's assume that's a fairly straightforward business. You're sourcing material, you're putting your brand out there. In most cases, you're not manufacturing, right? Either you're assembling or you're just adding your branding on top of it, and then you're selling onto the marketplaces. Of course, you have a website, but 90% of your sales is happening on marketplace.
That's a very good question. So I have seen a lot of D2C brands not raise VC money, right? And case in point is they're very profitable.
Correct.
But at the end of the day, it goes down to what are the entrepreneurs' goals? What are their ambitions? So VC money is like fuel, right? These D2C companies are very much working capital heavy.
Yeah.
So end of the day, if you want to turn, like let's say $100,000 in year 1 to $5 million in year 2, you wouldn't be able to do that just
without raising,
right? So I would say those that have an ambition to, turn 50 million to 100 million to $500 million in revenue, those would be the type of profiles that would and should raise money from it. Even if you take a loan from a bank, you can't take a large sum of loan.
Correct.
And VC money is equivalent to, in this case, equity, let's say.
Correct.
If you have more equity, you can raise more debt.
Yeah.
Right? So cumulatively, you just in general have more money to infuse into working capital to grow your business.
Sure.
Yeah.
Sure. Okay. We've wandered around a lot so far. Let's talk about Insignia and its investment thesis. Right. So what I have realized is that almost every fund which I've met, they have their unique insights. They have their unique assessment, and they have their own processes of checks and balances. Apart from the standard ones, there are other checks and balances which the fund goes through before, let's say, going ahead with the investment. How does a deal flow work at Insignia? Again, let's break it down into each piece, right? So starting from the first piece, that a founder meets you or an analyst, I don't know, but let's start from there.
All right. Maybe I'll give a bit of context as well. So Insignia positions itself as an early stage fund. We focus on investments across Southeast Asia. Actually, currently, most of our companies sit in Asia and Singapore. We can invest anywhere between $1 million to $15 million. So that's a bit of a context on how we position ourselves. When it comes to deal flow, the end-to-end deal flow, so usually, me or my colleague take the first meeting, and we have a few, I would say, check boxes, right? If we do think that the company ticks mark on the criteria.
What are these check boxes?
So essentially it could be as simple as, how big is the market? Is it at least $1 billion? Is the founder capable, whether it's through past experience or, does he show potential to keep motivated and learn and unlearn? Third would be, growth of the company is very important because we usually invest in Series A now. So how much are you growing in reality? Are you flatlining and you're flatlining like? So growth is a key metric for us. And economics, I would say. Economics, lastly would be valuation.
Last would be valuation.
Yeah, but of course not in any rank.
Yeah, of course.
But yeah, those are the things that we would ideally evaluate at the first meeting itself. After which, we can get a sense of whether this can be pushed to IC or not. So if all checks out, we will push for a second meeting, maybe, with our managing partner directly or directly with our IC.
Sure.
At that point, we run due diligence.
How big is the IC?
The IC is 3 people.
3 people.
Yeah.
Okay.
Yeah.
And they are, who are the IC? I mean, they're entrepreneurs themselves.
Yeah.
They are?
Yeah. They all are actually former entrepreneurs. So we have Yinglan, who was previously with Sequoia. He spent some time in the government as well. And then we have Aaron, who's a co-founder of Carro. We also have Tim, who was the former partner at Sequoia. All 3 of them either have their own businesses or formerly were entrepreneurs themselves. We actually pushed the investment through IC, but at that point, we've already run our
due diligence. Okay.
It's a due diligence.
Sure.
Right?
Sure.
So we come into the IC prepared, and for the partners to also have all the knowledge they need to
Make a decision.
make a decision. So we try to move fast. Of course, it's not as simple as, first I see decision is made.
Yeah. Sure. How long generally in this market, how long generally does it take for a deal end to end to complete? I mean, starting from the first conversation to funds transferred, for example, funds wired. How
Getting longer.
how long? Give us a average.
I would say around
3 months. What was this in 2021?
2021. I'd say 1 to 2 months.
1 to 2 months. Okay.
Faster. But also depends on the stage, we've seen seed stage companies also close in 3 months, for example. Maybe say it could be a bit longer. Because the FDD might take a lot more time. And it also goes down to, whether you appoint a third party for FDD, right?
Yeah.
So the timeline is not only reliant on the fund anymore.
Correct. Yeah. Just for everyone, FDD is financial due diligence. Okay. Fair enough. Let's talk about the founders themselves, right? Before I get into details of what qualities you look at and more, let's primarily talk about let's say within your portfolio, and then I'll go into the general segment as well. In your portfolio, how many founders are the second-time founders or third-time founders, and how many are the first-time founders? Just a rough number.
I don't have the exact number.
Yeah, rough.
Yeah, but I would say bulk of them are first time.
Bulk of them are first-time founders. Yes. Do you think this trend has changed? I mean, because earlier what we used to hear mostly is that most of them are like either second-time founders who were raising money or third-time founders who were raising money. But in the last 2.5, 3 years, you're seeing a lot of first-time founders coming in. Is it true? Or it's just my observation?
I think we're still seeing a lot of
First-time founders coming in.
We are seeing a different type of profile though now, right? We are seeing a lot of traditional entrepreneurs become
VC-backed. Okay, that's interesting.
Yeah. So like because a lot of traditional businesses now.
Give me an example.
Right?
Give me an example.
So not to name names, but a lot of the agri-tech companies that we've invested in, all the founders come from traditional.
Oh, nice.
Right? So
Nice.
there's a lot more traditional businesses being digitized, and because of that, I think a lot of the founders naturally come from very traditional backgrounds.
Sure.
Yeah.
Sure.
But I would say like all in all, bulk of the founders that we meet are actually first-time founders, if not this profile.
Sure.
Yeah.
Sure. Interesting. As a fund, are there any specific areas in terms of verticals or segments which you're like extremely bullish on? I understand you're very agnostic as a fund, but are there any segments which you're like super bullish on? Like for example, when I met Yanglan, he's very bullish on AI, right? I mean, he's out there. He's like hire PhDs, create models. But is there anything else apart from AI which, because AI is out there. What apart from AI is the fund very bullish on?
We're quite bullish on, I would say, fintech.
Fintech,
AI, yes, as you mentioned, agri-tech as well.
Okay.
Yeah, so I would say, and commerce, we are seeing a lot more models in
B2B commerce. Okay.
Yeah, but all in all, we are still very much sector agnostic, and everyone at the fund in the investment team have different sector focuses. That allows us to cover a
wide base. Interesting. Let's talk about founders per se, right? It's very difficult to gauge people in a few meetings. I mean, people are always at their best behavior, right? How do you go about it? I mean, what are the top or red flags? Let's talk about red flags, right? I mean, what are the red flags in a conversation or in a meeting, which is an immediate turn off for you?
For me, I think it may vary again if you ask different people. But personally, I think when you go in meeting a VC, I would expect the founder to be prepared.
Prepared with
Prepared with knowing their numbers, knowing their growth knowing their, 5-year plan, for example, right? Even if it's on a high level, what do you want to be in 5 years? So those are the things that I would expect them to know when they come into the meeting, right? So I wouldn't say it's a red flag, but it would be a yellow flag if, the founder itself, let's say, does not know high-level metrics about their business.
Fair enough.
Yeah.
Okay. What else?
That's
Give me some psychology out of it. Come on. Give me psychology. What other red flags? What are the other red flags?
I think the second one is not if you're asking question A, and then the founder responds to question B that was never asked, right? It's that I would say he's either the connection's really bad or he's not really attentive, if that makes sense.
Sure.
Or even if you're not attentive, right? I think it's okay to ask like, hey, could you repeat that question for me?
Sure.
Because being attentive is very important. You need to listen to feedback constantly. You need to listen to, what your investors want as well. What your investors are saying. It's a close loop.
Correct.
There's one telltale.
Yeah, but it's a pretty fair one. It's a pretty fair one. Do you hear a response from founders who are pitching to you? Do you hear this response that I don't know? If you hear it often?
I think we can't expect founders to know everything. We expect founders to
No, but of course. No, the point which I'm making is that acceptance very visible, that people are willing to raise up their hand and say that, hey, listen, I don't know.
Yeah.
It happens. It comments, which is good.
Yeah. When it comes to fundraise, let's say, they know the amount that they're able to fundraise, but not necessarily the valuation, right? And this also comes down to whether they're first-time founders or second-time founders. Sometimes they don't know what's the price in the market for their company.
Sure.
Right? And I think it's fair to say that, I don't know. What do you think about this?
Sure. That is good. That's good. Okay, I think we are towards the end of the chat. Let's hear your thoughts on some verticals, right? Some segments in Indonesia. So you can do a rapid fire kind of a thingy. Influencer economy. What do you think?
No, interesting sector.
Okay.
I think it's on the rise clearly, right? Indonesia as a destination for influencers. We've seen, TikTok influencers actually make millions in IDR.
It hurts.
And you start to question your career. So for the influencer economy, I think if we backtrack to like maybe 5 years ago, influencers were existent, but they were more so, I would say, actresses.
Correct.
That has a public image already established. But now we are looking at like a lot of different types of influencers. They're looking at key opinion consumers, right? Key opinion leaders. And it could be like even mega influencers, but also very micro influencers.
Correct.
Who have like 1,000 followers. So this economy was non-existent before because this economy only grew with social media.
True.
Right? So I myself, I am personally inclined to meet a lot of companies that fall into this economy. But the key question that we always ask is, at the end of the day, how big can you be? And are you better than a better operated agency, right? Because the influencer economy was very, very crowded with a lot of agencies.
Correct.
Now we're looking at a lot of digital platforms that are operating like agencies, but providing more added value. The question comes down to, how big of a business can this be if you just focus, let's say, in a market like Indonesia? And can you actually be monetizing from some of the transactions that these influencers make? I think that is very interesting. If you can make money of the transactions that the influencers are making, inevitably it's a big business because we know influencers that are making over $1 billion in IDR.
Yeah.
We went through one live stream.
Yeah.
Right?
Yeah.
But yeah, then that's my view in a nutshell.
Interesting. How about SaaS?
SaaS. SaaS adoption has been low in Southeast Asia
Low compared to US.
compared to US, correct. But SaaS I see is either you're a global first company, able to crack SaaS quickly, or SaaS becomes a supplementary, model to your core business. That's what we are seeing. But we like SaaS models. We really like them. We constantly hunting for SaaS companies as well. Because unit economics are very healthy, right? The path to profitability is very clear.
Very clear. But I mean, there has been a massive slowdown in investments in SaaS companies in the last few quarters. And I know quite a few SaaS founders, two good friends, and everyone's been echoing this sentiment that the whole deal flow has gone pretty sour. Why do you think so?
It could be because of the market right now, right? If we look at public comps for SaaS itself, they've dropped significantly. I think we're looking at single-digit price to sales, right? Still north of 5, but at one point it used to be 20, 30 times price to sales.
Correct.
Right? So I think that, and secondly, I think Southeast Asia has tried a lot of SaaS models, right? We've seen a lot of companies establish SaaS businesses, but the uptake has not been, or the conversion in this case has not been as high as common as fintech companies. Conversion to billion-dollar businesses, for example, or even multi-million. Yeah.
Yeah, sure. Okay. How about P2P lending? So, okay, before you... so in my experience, at least in Indonesia, it should not be called P2P lending anymore. It should be called banking channeled money to peer lending. Because most of the companies, they're basically borrowing from the banks and then lending it out. So the 1P from P2P is missing for sure. Okay. Okay. Now your thoughts.
I think for P2P itself, I'm speaking for Indonesia.
Yeah. Well, we're all talking Indonesia. Yeah.
Ecosystem, and you're already seeing category leaders in the P2P space, right? So for growth stage companies, I think P2P would be a very interesting sector,
Correct.
right? But for early stage companies, these P2P companies are really far too expensive for us to afford, and they are companies with very deep pockets, right?
Correct.
So there's more risk to investing in an early stage P2P company unless they have a different angle or a different entry point, right? So we are seeing a lot more vertical-based financing solutions. So it could be P2P, but they're targeting a specific
vertical.
Yeah. So they become really good at underwriting a client, let's say in construction, right? How you look at a client is also different, based on each industry. The way you KYC, KYB,
Sure.
a company,
Sure.
So now I think that segment is just rising, and it's still very nascent.
Nice. Sure. How about EVs and sustainability based other offerings as a market in Indonesia especially?
Yes. So we are seeing a lot of companies being established in the EV space. We have yet to make an investment there, but it is one of the sectors that I think will take a long time to build. So it's not a company that you can see turn $1 billion in 5 years, right? I think just like a lot of D2C companies, because of the market dynamics, I think it will take at least 10 years maybe to see a big company, unless regulation really changes.
Regulation pushes, yeah.
So it's a sector that we are looking at, and we've been constantly evaluating companies.
How about other sustainability companies, be it sustainable fashion or waste management? What are your thoughts on those companies?
Yeah, we've been looking at them as well. I think waste is huge, right?
In the yeah, true. Yeah.
So we've been looking at those models as well. I think end of the day, to become a big business in the waste management industry, luckily enough, and they start in the right destination.
Yeah.
Indonesia. So we've also been looking, but I think the price to sales multiples are not as favorable as SaaS.
Correct.
From an investor lens, I think that's something that we constantly evaluate internally on how we can see an expansion in the public market multiples in 5 to 10 years. But as mentioned, I think we're quite agnostic, and this is one of the sectors that we've been looking at as well.
Sure. Let's quickly talk about valuations, right? So 2 questions on valuation. Number 1, what happens when a startup raises money at a very crazy valuation, like it happened in 2021 or even early 2022? What happens when they raise money at a very crazy valuation? That is number 1 question. Second, what should be the valuation?
Okay. I'll start with the first one that you mentioned. So 2021 was a bull run.
Yeah.
So, case in point to your question, we saw a lot of companies raising at very inflated valuations. But that's also a factor of a lot of dry powder
Correct.
in the market, right? The good thing is, at that point, founders have a lot more cash in bank to experiment, right? If Model A doesn't work out, they can try Model B in 1 year, Model C in 2nd year.
Sure.
So it's a blessing in disguise for entrepreneurs, but it's a double-edged sword because end of the day, if they run out of the money, then they need to go out of the market, fundraise again. And let's say if they did raise at inflated valuations of 20, 30 million, will you be able to get your metrics up to speed to make sense of that valuation? So again, it depends on the amount raised. I think if you're raising like 20 million, then,
that's a different story. Yeah.
you have so much dry powder to experiment.
Sure.
Right?
Sure.
But founders have become very realistic. I think now, market has corrected and still correcting. So we've seen a lot of down rounds happen.
Oh, you've seen already a lot of down rounds happen.
Second question on how to value a company, right? For us, specifically, we really look at the public comps, right?
Okay.
How much are companies in the public market trading at? Because now exit is so important. Then when you think about exit, it's either through, M&A or IPO.
Sure.
Right? And on the IPO path, it's important for us to see at what valuation they can exit. Hence, that's why we look at a lot of public comps to give us comfort on how to price a company now and how much the company can be in the next 5 to 10 years.
Yeah. Sure. Sounds fair enough. I think we're good. I think we covered a whole lot of aspects. Do you want to talk about anything which you feel we should have spoken about but we missed?
Or maybe from your perspective, you're a founder yourself, right? What are the things, you would always ask VCs, but, there's no readily available information publicly, right?
Sure. So, okay. So one thing which we took this call when we started our fundraise, that we are doing a pre-seed round, and we took this decision that we will not do a VC round for pre-seed. And we figured this out very early. A lot of VCs were definitely interested in having a chat, but it was more of a meeting recorded in their books, kind of a meeting. So we took this call that, hey, listen, we'll meet everyone. We'll definitely meet everyone, not saying no to anyone. But every meeting will go with the mindset that, okay, we are going to raise this through angels or networks, the pre-seed round. Second, fortunately, we valued ourselves very realistic. So the angel rounds were very easy to trickle in. Also in this market, what we have realized is, especially if it's pre-seed, right? I mean, I'm not talking about seed, so pre-seed, very early, the first few checks, I think it's become very crucial that you onboard angels who can bring real value, be it in terms of product, tech, data, connections, apart from money. So my theory is, and we executed this, right? My theory is very straightforward. I want to have at least 10 such angels whom I can neither afford to hire or I can afford to pay them as consultants, but I want their services or expertise. So actually we handpicked our angel. And I want this guy. I want him to help us with our product, or I want this guy to help us with our analytics. It's purely because of the market dynamics, right? I mean, if it would have been, let's say, late 2020, early 2021, we might have gone a different direction, right? I mean, that's what happens in a bull market, right? I mean, we've seen companies raising 5 million in pre-seed and then hiring people from McKinsey and BCG and setting up these large teams. But the market is very different now. The dynamics is extremely different. So even when I keep meeting other founders who are just starting, my suggestion to them is that go for friends and family rounds. Look out for angels who can really bring value. Get some traction and then go for a VC money. Because you saying 3 months, the others on the podcast have also said 3 to 4 months. But the market reality is 6 to 9 months right now, even for seed rounds, is what I'm seeing. I'm again talking from the point of conversation. For the startup to close that round, it is taking right now 6 to 9 months to close that round. So make sure that your burn is as little as possible, and your runway is enough for not to die, right, while you get that venture capital money coming in.
It's good if you're pre-revenue, you're still ideating, to get some of these strategic angels on board, because they can also be your sounding board.
Correct.
Right?
Correct.
But I don't think any entrepreneur should shut doors.
No, absolutely not. Absolutely not.
One thing I would recommend all founders do is, put yourself out there, right?
Yes.
Because if you don't put yourself out there, you won't know what.
Correct.
It'll all be based on he say, she say.
True. Right? I mean, look, that's what we are doing over here with this podcast, right? I mean, no, I completely agree with you. I mean, that is something which we've decided internally. We don't say no to any meeting. Let's meet. If nothing, we'll learn something and know a new person.
If you're not busy. If you're busy,
of course. And look, the other part is that you don't need all your founders in every meeting.
Yeah.
So, like for example, in our case, we are very clear that, okay, either me or Danis will attend investor meetings or any prospective fundraising events, or be it networking sessions, because the priorities are very clear, right? That, hey, listen, priorities and responsibilities. That, okay, while there is one founder who's taking care of the operations, one's taking care of the tech, the one's out there shouting about the brand, and that's me, meeting investors. So that is very clear. Again, I believe I see this often, right? A lot of founders still get very, very swayed away with fundraising very early in their in the startup's life. I think it's again a double-edged sword. Especially in Indonesia, you never have a bad meeting. There's always a good meeting. Every meeting is a good meeting.
You always have something to take away.
Yes, and it can give a false sense of expectation, false sense of hope that money is gonna come in, because you generally don't have bad meetings. I mean, I think most people are very polite, right? So meetings are always good, but gotta be careful. money in is money in. What's money in the bank is money in the bank. Rest everything is out there on paper, right? I mean,
Yeah, no, accurate. I think founders have to look to protect themselves as well.
true.
To ensure that, in the next 6 months, if you're still burning, how do you make sure that even post-term sheet, if all of a sudden that term sheet gets pulled out, what happens, right?
And this is happening a lot.
Yeah, this has happened a lot in this market.
Sure.
Because I think UE is very important. So
Correct.
that's one thing that, founders should pay attention to, being able to ensure not on a P&L basis, but, take into account, let's say if you take financing, right?
Correct.
Take into account the interest that you pay to these financing companies are also factored into your unit economics,
True.
which I think 5 years ago, maybe this was not a core focus,
Sure.
right? At least on, prior to OPEX, you're making $1. You're making something out of the dollar that you burn.
Sure.
Yeah.
Sure. Okay, last question. I think we missed this one. How important is a startup to be post-revenue to raise money from Insignia? Is it mandatory?
In most cases, yes, because now we focus on Series A stage companies, and at that point, I think
The Series A, it's fair, yeah.
metric.
Yeah.
But I don't want to say a yes 100% confidently, because we've also seen companies like, Figma and the US, they were not making any money for, I think, around 2 to 3 years
Yeah.
when they made their first dollar. But at that point, they already raised a few rounds, right?
OpenAI for that matter, right? I mean, 6 years, zero revenue.
That's true.
Perfect. This was absolute pleasure. It was a breeze chatting with you, Shefali. Thank you so much for doing this. Guys, I'll share the details of Shefali, LinkedIn and everything in the description. Aspiring entrepreneurs can reach her. Thank you so much for doing this. Thank you.